Hi, I'm John Prasinos, Editorial Director of Investing Daily, with a video presentation for Monday, May 1st. To view our full range of trading services and publications, visit our website at investingdaily.com. Also visit the website of our subsidiary, streetauthority.com. Well, the month of May has just started. There's a familiar Wall Street aphorism, and you've probably heard it. Sell in May and go away. It's a catchy phrase that rhymes, but is it legitimate advice? There's a preconceived notion that the stock market loses steam during the summer months as investors and Wall Street insiders go on vacation. But the evidence suggests otherwise. Over the last 40 years, the average return for the stock market from May to August was 3.2%, which isn't a blockbuster gain, but neither would you want to pass it up. The market was higher in 75% of those summer periods, with the best May through August gain generated in 2020, plus 21%. The worst periods were in 1998, minus 14%, and again in 2002, minus 14%. Over the last 4 decades, the month of May has witnessed a stock market gain 71% of the time, with an average monthly total return of 0.8%. In those years when the stock market climbed in May, it went on to notch a gain for the full summer 88% of the time, with an average return of 7.4%. The upshot? Sell in May and go away. It's clever wordplay, but lousy investment advice. Meanwhile, the major U.S. stock market indices closed last week higher as S&P 500 corporate earnings came in better than expected, and the Federal Reserve's preferred inflation gauge showed that the rate of inflation is declining. The U.S. Personal Consumption Expenditures, PCE, price index took another month-over-month dip to 4.2% in March, from 5.1% in February and 5.4% in January, as you can see here. Inflation, it's still too high, but the PCE data, it cheered investors. Take a look at the following table. The Dow Jones Industrial Average gained 0.9%, the S&P 500 also gained 0.9%, and the technology-heavy NASDAQ jumped 1.3%. The benchmark 10-year Treasury yield fell 0.1% to sit at 3.42%. Last week, stocks finished in the green on Monday, Thursday, and Friday, and as you can see from this chart, Thursday and Friday witnessed particularly large gains. The U.S. economy is slowing, as evidenced by last week's release of the latest U.S. gross domestic product GDP report. GDP slowed to 1.1% in the first quarter, compared with 2.6% in the previous quarter and 3.2% in the quarter before that. However, if you conduct a deeper dive into the GDP report, you see silver linings. Household spending, the primary driver of the economy, increased at a robust 3.7% rate last quarter, considerably above the average of 1.7% over the previous 4 quarters. This spending should keep the economy from falling into a sharp recession. Corporate earnings reports occupied center stage last week, with markets getting a lift from better-than-expected results. For Q1 2023, with 53% of S&P 500 companies so far reporting actual results, 79% of S&P 500 companies have reported a positive earnings surprise, and 74% have reported a positive revenue surprise. For Q1 2023, the blended earnings decline for the S&P 500 is minus 3.7%. If that is the actual decline for the quarter, it will mark the second straight quarter that the index has reported a decline in earnings. But consider this. On March 31, the estimated earnings decline for Q1 was minus 6.7%. 10 sectors are reporting higher earnings today compared to March 31 because of positive earnings surprises. The banking and technology sectors in particular have surprised on the upside. Fact is, the stock market already has priced in most of a mild recession. The markets will soon start to focus more on the accelerating recovery. That's my view anyway. Now's the time to position your portfolio for the upswing. Let's take a look at the week ahead. Here are the salient economic reports scheduled in the coming days. S&P Manufacturing PMI, ISM Manufacturing, Construction Spending Monday, U.S. job openings, factory orders Tuesday, ADP employment, S&P, U.S. Services PMI, ISM Services, Federal Reserve interest rate and statement, and Fed Chief Jerome Powell press conference Wednesday, U.S. productivity, U.S. trade deficit, initial jobless claims Thursday, U.S. employment rate and hourly wages Friday. The big news, of course, will be the Fed's policy statement. Want to turbocharge your portfolio under these conditions? Consider Rapier's Income Accelerator, helmed by my colleague, Robert Rapier. In a special report, Robert unveils advanced orders for a shot at up to $1,390 in instant income each Monday. Think of this weekly windfall as a second paycheck. To tap this $450 billion income stream, click the URL at the bottom of the article that accompanies this video on the Investing Daily website. And if you have any comments or feedback, please send an email to me at mailbag@investingdaily.com. Thanks so much for watching.